Welcome. Today is Friday and I'm going to go over some smart money market structure for you guys today, just so you guys can know what to do, because smart money structure is important, because no matter what strategy you guys trade or what you do, depending if it's smart money, if you trade smart money, you do know that the ones that are actually smart money in the Forex market are the banks and institutions. And the banks and institutions, or the banks, can move the market through monetary policy, and institutions will trade levels based on their own analysis of the economy and whatsoever. So the fundamentals of any smart money strategy pretty much has to boil down to market structure, because market structure shows you who's in control of the market. Trend lines, I'm not a big fan of. I use market structure. I'm not going to explain why, because that's not why we're here. And but yeah, so the first thing I want to go over is talking about the time frames and why it's important to check different time frames. So on the 15-minute time frame, which we are right now, you can clearly see that structure is bullish, because what? We have higher highs, higher lows, where we have highs here, we have a low here, we have another previous low here, and we have another high. And if you notice, price came and broke this high here, came back down here, blah blah blah. It's pretty obvious that we're in up structure. Okay, we have two pieces of lower highs and two pieces of higher highs that confirm that we are indeed bullish currently. But guys, here's the thing: if we go on the higher time frames and check this, what do we see here? If we zoom all the way out, we see what? We see descending structure. We see bearish structure. Okay, and on the daily chart, what do we see? We see descending structure. We see bearish structure. And particularly, what do we see up here? We see a fair value gap / imbalance gap right above there at the top of the range. Right there, if you see it, what I just drew with the red right there on the screen. I'm going to do it again because some people are stupid. So right here, we had a gap right there. And right now, price is currently tapping into this area. So what I'm expecting is, because I have higher time frame structure, we have a high, low, lower highs, lower lows, here, 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 and here. So what I'm expecting is a break of structure, and that just simply means when price breaks a previous low or high that goes against market structure. Okay, so we want to see a break of structure that's aggressive. So what I mean by that is, okay, so we know price is in our POI, which, if you watch my channel, POIs simply are the areas of interest that I'm interested in trading. So those POIs can be order blocks, they can be fair value gaps, they can be imbalance gaps, anything like that, guys. So the one thing I really want to see right now is I want to see a break of structure happen right here. And what I mean by that, I know I said this twice, is I want to see price aggressively come down. You see the purple line? Come down and break this structure and this. What pieces of structure did it break? 1, 2. I want to see price come down and aggressively break 1 to 2 pieces of structure. And then, from that point on, price will have created a new range, created a new low from what? Breaking the structure, and that created a new low, and our high was the high that tapped into our gap. Okay? So, our new current range becomes the purple. Becomes the purple high right here, and the purple low right here. So now I know we're selling, right? So price broke down here, and I'm looking for a trade. Okay, if I'm selling, where am I going to sell? Okay, so in between this purple line, in between this top and this high and low, we want to look for trades at the upper part of the range. And like I said before, guys, again, the range is our current new high and new low. So the low that was new was the one that broke this previous structure on the purple, and the high was the high that created this low, because smart money probably sold up here. Okay, so what we want to do is we want to actually trade and look for entries at the top arrow area versus the bottom arrow area. Okay, because that is what's called the premium part of the range, where prices are more expensive, because it's common sense, prices fall from a higher price. And so we want to sell from the highest price possible. Even if we miss this initial zone right here, above here, it doesn't matter, because after every aggressive price action or volatility, there's always a retracement in the market. Okay, so there's always a retracement when the market comes all the way back up before going back down, or back down before up. Okay, and the reason is because when there's volatility through smart money and news coming into the markets, that creates those gaps, those fair value gaps that you guys know about, those gaps, those order blocks, those supply and demand zones. This right here, when I say this, wait for an arrow to pop up on the screen. This right here, this unhealthy price action, this aggressive movement going downwards was created by volatility. And people usually like to shy away from volatility, but we need volatility to make money because volatility moves the market. So if you're on the right side of the market, you can trade volatility correctly. So that's what I'm trying to say here. So this gap from this point right here that I'm pointing the arrow on, below, 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 lower, 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 look at all this unhealthy price action. And the reason why I say unhealthy again is unhealthy price action is when price goes either straight down or straight up without any correction. Healthy price action is when it goes down, up, down, up, down. That's healthy, okay? But yeah, this was just a simple video. I hope this helped you guys. Peace.